Hi, I'm David Stein, and this video is on should you invest in international stocks. Jack Bogle is the founder of Vanguard. He does not invest in international stocks. He's been teaching this for decades. He thinks they're too risky. He sees currency risk, economic risk, and societal instability risk. And as a result, he hasn't invested in international stocks. That's what he teaches, and he's been right. Since 1993, U.S. stocks have doubled the performance of non-U.S. stocks. So why should we invest non-U.S. stocks if performance hasn't been as good? Well, we need to look at the building blocks of those returns. What has happened since 1993? Stock returns are driven by the dividend yield, the earnings growth, or the way that the dividend is growing over time because earnings are growing, and what are investors willing to pay for that dividend stream or those earnings. In 1993, investors were willing to pay $22.50 for $1 of U.S. earnings. So the price to earnings ratio was 22.5. That was in 1993. In June 2018, the PE of U.S. stocks was 22.4. So it didn't really change. But if we look at non-U.S. stocks, they were also priced at a PE of 22.5 in 1993. But as of the beginning of June 2018, they were priced at 15.9. So their prices, their valuations are much lower. Now, part of that is due to technology stocks make up 26% of the U.S. stock market and only 6.5% of the non-U.S. stock market. And because technology stocks tend to have higher earnings growth, you would expect higher valuations for U.S. stocks versus non-U.S. stocks. But that's a pretty big gap, 22.5 versus 15.9. So on a forward-looking basis, the only reason to invest in non-U.S. stocks is if you think returns are going to be higher just because of the currency risk, the economic risk. Let's look again at those building blocks. The dividend yield of non-U.S. stocks right now is 3.1% versus 1.9% for U.S. stocks. So even if earnings growth or dividend growth is the same, because non-U.S. stocks have 1.2 percentage points higher dividend yield, they should outperform over the next decade. And if we assume that U.S. stocks will get cheaper or non-U.S. stocks will get more expensive, then again, non-U.S. stocks should outperform U.S. stocks. I assume non-U.S. stocks will return 6.1% over the next decade. That's developed non-U.S. markets versus only 5% for U.S. stocks. I assume emerging market stock, developing countries will return 7.8% annualized over the next decade. These are nominal returns before backing out inflation. Why do I think that? Because of the higher dividend yields and the lower valuation. So I'm willing to put most of my equity exposure, my stock exposure, in non-U.S. stocks, and I mitigate that currency risk. The fact that the dollar can strengthen and weaken, that impacts my returns. Over the long term, it hasn't made a big difference, but the short to intermediate terms, it definitely can make a difference. So I hedge about 50% of my non-U.S. exposure by buying an exchange-traded fund that invests overseas, but does it in a way that it hedges the currency risk. That's why I invest in non-U.S. stocks. The only reason to do so is if you think returns will be higher than U.S., and if you don't, then stick with U.S. or investing in your home country. If you'd like to learn more about investing, I have a free investment course. It's called How to Invest. It's a free email course. You can get more information at howtoinvestmoney.co. That's howtoinvestmoney.co. If you have any questions on this video, go ahead and leave them in the comments. Thanks.